presentation that I've now seen Alioune do 3 times in the last few days. We're going to have a little bit of a conversation about fund structures. So I'm going to ask each of our panelists to quickly introduce themselves. I've got a few questions. We're going to make this nice and short, but hopefully pretty insightful. So, Ido, why are you on the stage?
Because Christoph invited me, but otherwise I spent the last 19 and a bit years on the intersection of Africa and tech, 15 years in VC, and currently thinking about what's next for me, but some experience in the space for the last few years.
Maisa?
I'm here because I was threatened. No, just joking. I'm here because my good friend Alioune kindly invited us to speak about this topic, and I think it's a very relevant topic for what's going on in the ecosystem. I'm currently the head of Africa for venture capital at IFC, the World Bank. So looking forward to the discussion.
Alioune, I'm pretty sure they know why you're here.
Yeah, I spoke a lot already, but mostly to push people to speak and to challenge the status quo, essentially.
Yeah. Excellent. We can do that from both sides, but I mean, we've got a pretty, I think, pushable panel here. So I think one of the things, Alioune, that's great about the research is that it opens up a wide variety of options for fit-for-purpose capital. So if we were to go back or forward in time and redesign the Silicon Valley venture model in Africa, what would we keep and what do you think we would leave to the side? Ida?
I think we may end up in a few years in something that is not necessarily different, but for where we are missing a bunch of components, and as such, I think that we are using a model that doesn't address a lot of them, and by a lot of them I mean the nature of the capital. So the capital, we use equity for everything,
right,
which is nice, but also very expensive and pushes price up very early. We get very little flexibility on the in and out,
yeah,
because we have lack of liquidity at the end, and we are struggling to tie incentives between the providers of capital and the students of capital in that regard. So I would have in mind that something different. It's also said that funds in their current structure cannot work, but I would think slightly wider to address those gaps.
Absolutely. I say you've spent some time in the US as well, in the ecosystem. What do you think?
Well, I think the conversation around the instrument is spot on, right? We need to basically be equipped with the tools to do what we're trying to do.
Yes.
But something that I would have changed is also the way we engage with the ecosystem. And when I say we, it's investor to company. Because there's always been talks about unicorns. Let's chase the next unicorns, and unicorns will drive exit. But Africa is not a unicorn market. It's an SME market, right? And when you draw conclusions and you draw parallels with other markets, it actually is the same. What is the driving base and value of growth and prosperity are SMEs. So maybe our venture capital models should be built around how to optimize SME value versus chase unicorns.
I completely agree. Something that I often say is that, instead of chasing unicorns, we should be building gazelles and zebras because they actually exist. Like really. And here, they do.
Yeah.
Yeah, Alioune.
Yeah, no, absolutely. We've touched on it. And I think what comes up of the research also is that there's actual appetite from fund managers to do things differently.
Yeah.
When you actually challenge them and ask them to, pose on what they've been doing for the last couple of years, they actually do innovate and they actually come up with fund structures that are fairly interesting and definitely that look at least better fit for purpose. But of course, there's also pushback, right? Because it's good to come up with the concept and the idea, but you need to be able to raise for the product. And we also have a lot of work to do at that level, and push LPs, institutional LPs, to support and adapt the change that is required and that is requested from fund managers.
Yeah, yesterday we did a roundtable with LPs, Alioune and I did, and one of the, I think, pieces of feedback that was really interesting was around changing the narrative of alternative funds to you should give us more time because, you know, it's harder to do things. We need more time. You need to be more patient, to here's the value you can achieve if you give us more time and a broader toolkit to do that. And I think it's good feedback because, you know, LPs do not owe GPs anything, but it's up to GPs to make that value creation. So, you know, as you're thinking about how potentially other markets that you've seen have do that, what would be your advice to fund managers thinking about that?
I think that, you know, the patient's capital thingy is a bit of a pile of crap. In other words, no one wants to get lower IRR over a longer period of time. That's a non-offer, right? Let me give you less over more time. It's just not a very attractive offering. So the patient capital can only be patient if it can do, you know, if it pays either a much higher IRR at the end or otherwise starts generating revenues earlier on through using, again, debt, working capital facilities that spit out interest and so on and so forth. But just being patient, I mean, yeah, that's charity, which is a great business, but it's not ours. So I think that is a bit of a confusion that we tend to stick to and maybe need to part with, because it seems like LPs are not that interested in it as well.
No, absolutely. I said, what have you seen from so I'll tell you that I know that multiple of the big DFIs, particularly ones like IFC that have been in the market early, are sitting on year 14 with a lot of the funds that they've invested in. So what would is there something that the fund managers could have told you up front that would have convinced you to let them have a 15-year fund instead of a 10 plus 1 plus 1 plus 1 plus 1 plus 1 plus 1?
I think it's always a good thing to look at data and things in perspective. Today we're saying it takes a long time to return capital in Africa, but do you know what's the average time to return a venture-backed unicorn in the US?
No.
It's 10.6 years.
That's for unicorn. Fund ages in the US is 16 to 20 these days.
Yes, he said it. So this is not an African problem.
Yeah.
It is a characteristic of this asset class. Now, once we've moved past this self-pity feeling, to be honest, of saying we need more time because we're special, we're Africa, you actually look at why do we need more time and why is it acceptable in the US that it is a 10 plus 2, but in reality it's 16 and they don't complain about it, but we do. And a lot of that conversation comes from the realization that investment is a life cycle. And your LPs will be okay with that as long as they see value in that life cycle. So for me, the whole conversation around extending life cycles of investment, African funds, is a non-starter. It's not going to happen. As you rightfully said, if I'm an LP and I'm getting money somewhere else with a shorter life cycle, or I'm getting it with the exact same life cycle, but I'm getting more, then why am I compensating an African GP to give me less?
But I don't think that's the request. The request is, I think, for many of these funds, and again, the thing is you're not getting it elsewhere. You're sitting in these funds at 14, 15 years across different life cycles. I just happened to have taught a course for 40 of your fund managers in May, and I know that many of them are far past their 10-year. So you aren't necessarily getting it, but you're asking for the optionality. And I think this is where the conversation gets interesting around value creation. I completely agree with you. And this is where I think, Alioune, the work that you did was really important because it's not just longer, because just longer on its own is not compelling. But what if our fund managers told you that in order to build gazelles and zebras, we need a longer fund with multiple tools? Is that then compelling for you?
Well, we're already giving it to them.
So, I mean, yes,
the concept
I do get
of
that.
continuation funds, the concept of, recycling your assets, it's not new.
No.
But we also have to understand that, especially for DFIs, we have a fiduciary duty of returning capital, returning it efficiently and timely. So today,
But
if
that
I'm
timing
saying,
is
Let
made
me
up.
challenge you here, as I currently, am not on fundraising, so I can happily do that. You are not, right? So in so many words, you are probably the most constraining beast on earth as an LP. And I think that, there are constraints around what you can invest in. There are constraints that are very unique to the geography. There are constraints about how many boxes you need to tick alongside return, which are non-commercial boxes. But I think to your point of you're allowing, multiple tools and so on, you're not allowing it in the same fund. Let's not, confuse ourselves there. So you're allowing equity only in equity-only funds. Yes, you could do debt if you're a debt fund, and you could do venture debt if you're a venture debt fund. We don't have many of those in the region. But you're not allowing to a lot of flexibility with how, for instance, in the LPA, historically, you could only give a loan if it's sub 12 months at very specific terms. So you can't really play in that regard of creativity.
And I would also take umbrage with the idea that your mandate, as with the World Bank money that you have, is to create development, not to create returns for the World Bank. And it's not to create short-term returns, it's to create long-term development. And so this is I was speaking with one of your compatriots in a different fund that has a 20-year European Commission guarantee themselves, but will only do 10-year funds. And then pushing on that. Well, that's what we've always done. There's no actual, and I would say it's very similar actually for the IFC. There is nothing in law. You do 20, 30-year debt funds all the time.
So I think this comes again from the misperception of what is money for the World Bank. We have at the World Bank what is the EBRD, which is the Bank of Reconstruction and Development, which is our tool for grants, institutional support, public advocacy, and all of that. That needs funding. How is it being funded? Through donors. And we've seen increasingly that donors, which are countries, but they don't have the money anymore, or they don't have appetite anymore. And it's been the case, and it's even more the case now, that when this gap happens, it's the IFC, which is the private sector arm, which has to provide returns to fund these activities. So, yes, we are commercial. We're a commercially driven impact vehicle. So the same way that in the commercial world, people want return adequately within a timely framework, we want to. So now there's always a notion of patient capital. Patient capital has to be taken in the whole context of what the bank offers.
Yeah.
Meaning blended finance, long-term loans, which is not what we do in private equity.
Of course not.
And of course, equity returns, which are risk-taking investments. So they help basically cement and build the base of this ecosystem, which is a bit more risky, but it comes with the expectation of return. So it's a bit hard to want things both ways, meaning you want the patient capital and you want also IFC to take more risk and be more commercial. So there's a word in between, and I think this is where us, DFIs, sometimes we battle with the perception that our money has must always be patient across all of our verticals. For the venture capital practice, it is not the case.
Elian, you want to talk about...
I think I would like to reframe the discussion, because the fund managers we are speaking with are not saying that they want patient capital. They're saying that they want longer term in order to better align their fund economics with what the market requires in order to generate more liquidity faster for the LPs. So the conversation really needs to be reframing and not thinking in boxes. And I also push it towards fund managers as well, because it's not taking one item, changing it. That's not how you generate performance.
Yeah, absolutely.
We need to completely rethink the model. We need to innovate. And it's challenging, right? Because it's new. It's trying to find something that works out of something that doesn't work, and that will take iteration, for sure. But that will take also experienced managers trying new things, but they will need to be backed by commercial capital that actually want return, but that understand that in the way they're funding funds today, that's not return generating.
I think that's the key piece of it. I think that's the core, and I love that's what the conversation we're having is that, again, become like the original question is, it's about value creation. So saying to LPs, here's all the things you're looking for. we want to give those to you. But in order to do that, we need to build funds that look differently, because the constraints, and I think this is what came out in the research, the constraints that are put on there are actually impeding that ability to do that. And I think this is where that open conversation needs to happen, and it has to be, and I think it is, I completely push also onto the GPs to say to the LPs, not, I need this, you should give me this, because you can. More, you need these things, I want to provide these things to you, and this is what it looks like. And I do think there's the impetus to be able to show that this works. And I do think having experienced fund managers be able to do that. And I've heard multiple times from people say, I really want to design a fund this way, but it's my first fund. I know it's hard enough to raise, so I'm going to do it on the second fund. And that, I get that. That makes sense. Ido, how many funds has Telecom had now?
2 in Africa and a couple in Europe before.
So if you were to design a new fund now as your next iteration, what would it look like?
Probably smaller, so a few tens of millions, holdco structure with sub-SPVs for deals that allow me flexibility in the sense that I can do. So I think we've talked about it, but there is many times misuse of capital, which then pushes pricing and so on. So if someone needs 5 million, of which 3 are working capital, I would like to give 2 in equity and 3 in working capital, be able to retain the 3 in working capital with whichever interest, and most people would pay today 20 plus in dollars. So that means that within 4 or 5 years, I sort of de-risked my capital base. I can start paying out IRR, and then I have an upside. Of course, it's not for all business models, but theoretically, that's how I would think about it. Then also with these, if you build the business with the right capital structure, you can exit it at potentially lower number, and still everybody can go home happy. I think there's a separate something we have not touched on. How do you incentivize the potential buyers here, which are less so the Googles and Amazons of the world at this point, and much so the local conglomerates and groups, and how do you tie these incentives at the gate? But that's a longer, separate discussion.
And I think that ties into another discussion around what we talk about a lot is obviously mobilizing local capital, and that's something that the DFIs would love to as well, to come in and catalyze local capital. And I think, to your point earlier around if we're looking at gazelles and zebras as opposed to unicorns, that actually might be a more compelling case to some of these pension funds that understand their local economy. And I think, just to close, Alioune, do you want to kick us off? I'll ask each of you to just talk about what do you hope that in 5 years, if we're sitting on this panel talking about fund structures, what do you hope that we'd be talking about? What type of trends?
I hope we'll be speaking more about funds that do generate liquidity. To answer to the same question that you asked, Ido, I'd probably do a secondary fund. We'll go out and pitch to founders. You can get X million from me, pledge the shares of that you hold on your company, buy out your cap table, and I'll be paid out through dividends.
I love that idea.
So more liquidity generating fund structures, assets across the continent, definitely part of the mix.
Mesa?
I mean, I agree with you. I think it's a mindset. It has to be a mindset that shifts towards compounding value, because when you compound value, then your liquidity options expand.
Yeah.
That's when you can leverage structured exits. That's when you can actually tap into banks. That's when you create an ecosystem of CVCs. And it is all, again, a chicken and egg issue, but I think today what we want to see in the ecosystem, and is already happening, is GPs take initiative and say, okay, if we were a startup today, we are at a pivot point in our startup life. So we're seeing that being a bit more of a thinking venture, that we're seeing traditional financing solutions, aka SAFE, being left behind to come back to more structured instruments that provide alignment. So I think we're getting there. And the expectation that our ecosystem, which is exciting but new, has to get it right. Yes, early not broken, has to get it right now. I think is wrong. We still have a little bit of time.
Yeah.
Yeah.
Ido, early not broken?
Early, no broken. Yeah, I think, again, we get the early discount, but with that, given the things we don't have, which is government grants, R&D, credit lines, and so on and so forth, some of it will need to be incorporated into how we adjust the return and the risk into our investment vehicles. And I think that is a bit of a more holistic thinking process rather than just trying to fix for the one.
Excellent. I apologize, I am 25 seconds over, but I will close it out there. Thank you all very much.
Thank you.
On the other team, thank you very much. Fabulous discussion from one panel to another. Unlocking what, Kino? You must unlock. It's been a day. Unlocking Christoph's bank account. No. Unlocking climate finance for Africa's growth. And this panel will be headed by Craig Atkinson, the co-founder of Future Motion Africa. Please put your hands together for Craig. He's going to introduce you to the panel as well. Thank you. So yeah. Where do you want me to sit? Good. Okay, good afternoon. Oh, that's quite loud. Good afternoon, ladies and gentlemen. Very excited for today's panel, and we have some amazing guests on stage with me today. So, to introduce our panelists, I'd like to do one at a time. Let's see the order. Yes, we're in the right order. Can we please welcome Claire Njoki from Investment Alpha Mondi onto the stage. Then up next, we have Simon Schwal from Oko. Then we've got Lisa Johansson from Green Cape. And then Jonathan First, Climate Policy Initiative.
I think he said, yeah.
You're going to, all right. So, today's discussion is something that I jumped at immediately when I was asked to be on this panel, because as a startup and as a business owner, trying to find capital is one of the most difficult things, especially in the space of climate and doing things that are often good and doesn't always come with the highest commercial rewards, such as like your top-of-the-range AI type of technology or big software companies. However, you're trying to do something good as well, and trying to tap into the climate financing pockets of money is what we're going to be speaking about today. Also been to a lot of these conferences where you talk and you talk and you talk, but there's no tangible outcome. Every year we come back and we talk about the same thing over and over. So today with our panel, we've got experts that's going to tell us how we can actually move forward and make sure that we have something to look forward to in the future. So I'm going to start off with Claire. So Claire, there's a lot of money in this ecosystem, and we were talking about your blended financing. What would you find is the most lucrative, balanced way that companies can be approaching climate finance?
Great. Thank you so much, Craig. And it's a pleasure seeing you all here and being part of this wonderful panel. My name is Claire Njoki. I'm the Investment and Program Manager at Alpha Mundi Foundation, where we work with small and medium enterprises across Africa and Sub-Saharan Africa within the nexus of climate and gender. And so, Craig, to your question, yes, so as we work with SMEs, we work with SMEs in different stages along the capital continuum, and we do have some that are quite early stage, others are further along, and so I will answer focusing on the more early stage companies because it's a little difficult for them. But for this stage, you find that especially for climate finance, a lot of financing is needed to provide technical assistance to them, which is one of the archetypes to blended finance. And so this supports the preparation of the transactions to make them bankable to support them also with compliance, capacity building, so that other investors feel the comfort to come in. We also see a lot of fast loss facilities coming in these transactions. To give the investors a level of comfort. I think earlier in the day we had about the need for more debt into these companies and not just equity, and the fast loss facilities are supporting with this. I think another important instrument, I know we're very tight on time, so I will just add this, is guarantees and local financing. I think that's also something that's very important because the burden of the foreign currency repayments, for example, in the case of debt, is quite high. And so looking at some local solutions to some of these problems, for example, in Nigeria, we have InfraCredit, which has come in to support with some of the local currency challenges. So I'll pause at that just to keep the conversation going. And I know I'll add a bit more to
Well,
that.
thank you, Claire. Now, that was some fascinating news. I'd actually like to pass this panel, talk about how these different structures between like Nigeria you were mentioning that's got their own mechanisms in South Africa, and how we could actually learn from each other to move things a lot faster. But to continue with the panel, I've got a question for Lisa. All right. Green Cape's done a lot of fantastic work, and you've obviously worked a lot in my previous businesses where there is employment that is also part of the ecosystem. So climate finance must do more than just cut carbon emissions, but also gain employment and create jobs in a new sector, especially when old sectors are starting to lose their working relationships with people. How do you, as Green Cape, see that as an evolving future?
Perfect, thanks so much. Is this thing on? It is.
Here we go.
Good. So Green Cape, an economic development agency, our North Star is investments and job creation into South Africa. How do we do that? We build projects around how to actually address those sort of barriers and sticky points in the market in order for us to drive those. I think that there's a number of different ways with regards to job creation, and one of those being that there are sort of one of the certain projects that I work on is called the Green Outcomes Fund, and I know Jonathan is also one of the major architects of it too. But how do we actually start looking at outcomes-based models within our funding structures in order to actually create and reward a certain type of behavior or investment behavior that we want to see? So particularly in the Green Outcomes Fund, we're looking at how do we reward fund managers for creating more jobs in the green economy. So the hypothesis being, there seems to be a bit of a reluctance, a little bit of a slow coming to the market with regards to climate tech. It is perceived as quite risky. So how do we actually incentivize fund managers to start looking towards the green sector, to look towards climate tech? One of those ones is an outcomes-based payment system where for every green job that is created post-investment, that an outcomes payment happens. So there is that side of it where we can look at, this could apply to anything, by the way. Outcomes-based payments can actually apply to whatever it is that a certain funder or anybody needs to actually see that certain change in the market. I think obviously from a different sort of angle is that there's loads of different models that actually drive this type of behavior. We've got, yes, the Youth Employment Service, where we've got a lot more sort of job and delivery towards particularly youth. And yeah, I think that I'm going to pause. I know we don't have a lot of time, but particularly looking at a certain solution is this sort of a green outcomes-based payment. Any sort of outcomes-based facility is something to consider within these structures. South Africa is renowned for it being a very stable banking foundation, but it also means we're incredibly risk-averse. So also being able to kind of see how we can work around that in order to make it work for both sides. And I think particularly in the Green Outcomes Fund, what's been shown is that green investments are particularly attractive, that they do have the legs, they do have the sort of the backbone to actually withstand the test of time. Yeah, Thank you.
Oh, that's amazing. Thank you, Lisa. I couldn't agree more with what you've said, especially the outcomes. There was a fund in my previous business that we ran with for about 2 years called the Jobs Boost Fund. And that was fully outcomes based. And you see people start really putting the work in because they know it's not just like free money and there's no real accountability. So I couldn't agree more with that. So next question is going to be to Jonathan. Jonathan, so there's a lot of local banks and finance institutions in South Africa, but they seem to be not clued up but removed from the climate financing sector. How do you see us linking with them and really starting to accelerate that on a commercial level from a bank's perspective as well?
So Craig, just some context very quickly. So Climate Policy Initiative is known for a number of things, but 2 things which are relevant today is we do what we call climate finance mapping. We've done South Africa with Green Cape, but we've done Africa and we've done many countries in Africa. So we understand where the climate flows are. So that's number 1. Number 2, we run 2 programs that develop financial instruments. One is called the Global Innovation Lab for Climate Finance. And the other one's called the Catalytic Climate Finance Facility. So we have a lot of knowledge both on terms of climate flows, but also a lot of instruments and how they're used. I think the question is wrong. I don't think it's accurate. So you can take South African banks as an example, but take banks in Africa. I don't think they're scared of climate finance. I don't think they're not committed to sustainability, quite the opposite. You take Standard Bank. Standard Bank's got 20 operations in Africa. ABSA's got 18. You've got Zanaco in Zambia, which is accredited to the Green Climate Fund. You've got the Commercial Bank of Kenya, likewise. You've got Rwanda, which has a green bank. You've got the DBSA, which has a green bank. That's not the issue. The issue is we struggle to find investable projects. This is said at every conference I've ever been to over the last 10 years. That is our struggle. Struggle is not money. The struggle is investable projects. And so we've got to improve the projects that are presented to the banks. It's not incumbent on the banks to go and find the projects. It's incumbent on the developers, the investors, the business people. But they've got to put them in a format that the banks can look at. And I think that is the issue. It's not that the banks don't have money. It's not that the banks are scared of Africa. It's not that the banks are scared of climate finance. They just don't have the projects or the businesses to invest in. Thanks.
I'm going to stick to this topic a little bit because it's interesting. So the banks do want to invest, I must agree. However, a lot of the projects that you're saying are not investable, if that's the right word. They haven't had the chance to prove something. That it's not like they've got, let's say, for example, Apple, and you're competing with Apple. You go, hey, I'm also creating this really smart computer and cool cell phone and whatever else, and you can see there's a history to it. A lot of the new technology and stuff in the climate space is brand new, so it's difficult to prove that concept. Banks don't want to bank the unbankable. You don't have like a 3-year track record of this thing doing really well. They're not going to loan you money on the merit of just saying, hey, we're good people. How do you see that? Like, how do you get to that point where the bank says, we like working with you and we want to see this thing go forward?
So, to be fair to the banks, they are taking your money and they're lending it. So I think also as depositors and shareholders of the banks, you wouldn't be too keen if they start putting their money into things which could result in losses. So I think you need to understand how banks fund themselves. They don't fund themselves with their, the employees' money. They use your money. Okay, that's number 1. Number 2, if you look at project financing, and I really like project financing because I find it quite simple. You've got a number of risks you have to deal with. The one is technology risk. And we have this saying, and it's not only the banks use it, is the technology commercially proven? That's all they ask for. Is it commercially proven? It's not an idea, it's not a pilot, it's commercially proven. And that's quite easy to do. The second risk they look at is what I call performance risk. So the ability to perform, whether it's a project or a business. And the third is the credit risk. Who is going to pay back the loan? Who's going to provide the returns? And I acknowledge there's a massive gap between the startups and the post-growth. I'm acknowledged. And I know that that is where businesses struggle. But to be fair to the banks, that's not the place the banks have to play. That's all everyone else. That's the venture capitalists, the development capital providers, the DFIs, etc. And I know there's not enough money in that area, and that's the problem. So I just say we need to differentiate between what the banks can do and what they can't do, and not expect them to do things which we know they cannot do, or we think they can do, but we know they cannot do. The issue we face is that sort of pre-growth, sort of post-growth, or development stage, which is, you know, before you get to Series A or Series A and beyond. That's where the real challenge is.
Can I add something to that? Sorry, just with regards to institutional capacity, I think it's something that's come up within our conversations at Green Cape, and particularly looking at the South African green finance taxonomy, is who's actually going to pay also from an institutional capacity to actually have the technical knowledge. Sometimes there are just new technologies that are coming online, and who is going to actually be able to bring the credit committees up to speed on what that actually transpires to, like translates to. We hear about black soldier flies. I know you probably know about it, but like, what is that? What does it mean? What are the returns? What is it? So there is a level of also technical capacity, institutional capacity building that is also required within banking institutions. But certainly from my point of view and the institutions that I engage with, there's definitely a willingness and a want to engage in this environment.
Yeah, absolutely. I've just been in this space, and it's a weird one for me because of technology. We've spoken to all the banks, and we had a good track record, 4 years and proven record, and they were still like, how does an electric vehicle work? What is your depreciation? You can't compare it to something else because it's a new bit of technology. So it was just back and forth for quite some time. We were funded eventually, but it wasn't as easy as, you know, going in and trying to get a loan on an ICE vehicle, much easier. But Simon, let's not leave you out of this conversation. We're actually building onto this. I'm enjoying this topic. So Africa has access to billions in global climate finance, yet only a fraction reaches the projects that need it the most. What do you see as the biggest barriers preventing Africa from unlocking these funds at scale?
Thank you. And first, I think I'll explain where I'm speaking from. So I'm the CEO and co-founder of OCO, and at OCO we provide climate insurance for agriculture, meaning an insurance that is going to pay the farmers if unfavorable weather is detected in their location. So we are in this situation. We are growing, but we are still pre-growth, pre-Series A, and we are looking for funding. So I'm looking at where the funds can come from, and we are a good recipient, I would say, for climate finance. So I see these pledges for financing. It can come from the World Bank, the European Investment Bank, etc. And it doesn't really trickle down to organizations like ours. And an example is the Great Green Wall, for example, in Sahel, $19 billion pledged, only $2.5 billion deployed so far. So yes, there is, the first problem is bankability. The projects are not bankable. They don't have predictable cash flows, they don't have watertight contracts and low risks, except for large renewable energy projects that are more suitable for banks. But the most impactful projects often don't have this financial return that's tangible or predictable financial returns that the banks expect. There's also the problem of bureaucracy. Obtaining this money means going through feasibility studies, impact assessments, which the smaller recipient companies cannot always generate. So the money flows from the, let's say, European Investment Bank, World Bank, to the large banking institutions, and it's kind of stuck there. So what needs to be done to unlock this money is, I can think of a few things. First, there are guarantees. So first loss guarantors that can make the projects more bankable for banks. That's, for example, the Farm Fit Fund by IDH is doing this, and we're trying to be part of that. The vehicles can be also adjusted. So I was talking to Holocene, which is a early stage climate fund, and they say that they're trying to adjust their fund, make it more suitable to receive this kind of climate financing. But the last thing, I think it might be a bit, we might not agree on this, but I think the banks might not always be the right recipients for this climate finance. Maybe some of those big institutional DFIs should fund more the VCs that know how to manage risky projects, that have another grid to assess risks, and that can maybe themselves be a good recipient for the funds, and then they have more possibility to let it trickle down to the projects. My company received investment from Catalyst, and Catalyst, for example, received money from the Climate Finance Lab, which is doing this bridge between the Green Climate Fund and VCs. So I think that's a big part of the solution that we should look into.
Brilliant. Thank you, Simon. Okay, Claire, you're up next. All right, so I'm going to change this question up a little bit in a different interpretation. So if we look at climate finance projects, right, we always, as founders, as business owners, always go, what is the safest route? But it doesn't always mean the safest project is going to be the project that's going to actually stand out and solve a problem. When things look complicated, people step back. Now, in your experience, how would you, as a founder or a business owner that has something that's a bit more complicated than just your general ABC type of business, how would you say the approach is for that type of finance, and how do we get more financing for those type of projects?
Yeah, that's a very exciting question, because I think the world has very complex problems, and at times we do need complex solutions. I think sitting on the side of the funders, something that we do need to do is put in a little more time to understand and to learn. Taking a leaf, borrowing a leaf from the innovators themselves, entrepreneurs, and actually learning some of these business models, because at times we can be a bit lazy about doing that, and I think it's important so that we're able to understand, because people put in money into things that they do understand. So I think it begins with that. It begins with understanding where can I add value as an investor, and collaboration as well. So how can we work together to actually build solutions that fit both sides of the table? And as we've had, for some investors, some solutions might not be the best, but that doesn't mean they're not investors that maybe are a little less risk, interested in more risk. As an example, we have some more nimble investors when you're looking, for example, at philanthropies rather than banks. When you're looking at the DFIs, they do have capacity to take up more risk. And I think we need to be a bit bolder around that. We need to be open to actually putting ourselves out there and taking that risk. So that's something. And then I think there is a conversation around redefining bankability. As things change, it's very, we will need to change how we look at bankability. For example, when you're looking at seasonality, we're looking at the agricultural sector. When you're looking at structuring repayments around that, how flexible can we be so that we can align to how the revenue streams are working, how the cash flow is working as well. So there also needs to be a bit of innovation in terms of the instruments that we're using. Lisa shared the outcomes-based instruments as an example. So we do work with an instrument called the social impact incentives, where a company unlocks incentives when it creates impact, and this can be used to bolster some of the revenue streams. So these are some of the things, especially around innovating on the financing models and how you approach and review and assess some of these businesses. But I think at the end of the day, there has to be a lot more collaboration in the process. We need to bring funders to the table to understand what is going on. So there needs to be a lot of capacity building, as Lisa and Jonathan have shared as well. And I think that's very important. Yeah.
Fully agree with you. Okay, so we are pushing a little bit on time. Lisa, from a Green Cape's perspective, you've got, you work a lot with the SMMEs. That's how you've met us. We were an SME at the time. And going to Jonathan's point, where a bank should not be the one funding the high-risk projects. Everyone has to start off as an SMME. So what is, maybe let's talk from a South African context, because we we have quite awesome structures in place here when it comes to funding enterprise development, ESD and BEE type of spend. How would you see that unpacking to create the SMME and move them to a point where they can be funded and move forward into the QSE space with bank funding and bond funding?
Thanks, Craig. And just to make mention, is that on?
No.
Craig, you and I met at Climate Finance Accelerator. It's one of a international UK-based technical assistance program. It's been running for 3 years in South Africa, and we're now going through our 4th cohort, sort of launching fairly soon, looking at about mid-December. Very much specifically looking at mitigation projects, climate tech projects, all businesses. And so, yeah, that will be coming up soon. But what it is that I think within the climate space, there's definitely an ecosystem of these accelerators, incubators, that very much collaborate and feed into each other. And one project then graduates into the next. And we do see that and witness that. And I think there's a healthy progress through that. But of course, we need to be able to support the guys that are actually dispersing the smaller ticket funds. It's not the sexy space, let's be honest. Like, everybody wants the big ticket size. We call it the Goldilocks effect, where it's a little bit too small, it's a little bit too large, you just want just right. And unfortunately, yeah, it's a very tricky space because it's the really small, nitty, the small stuff. But those guys are absolutely critical. And the sort of the names that I'm thinking about is obviously Kinjani and Savant and Viridian, and you know, there's KR Ventures, where that's really small ticket sizes that are going into project development and then providing technical assistance on top of that, such as Savant's build program. So a lot more support with regards to ensuring that those the ecosystem thrives, that there's not just, you know, you get through one accelerator and then that's it, that there is some sort of level of perhaps grant funding or proper, that there's actually some level of funding that is available to you post that. I think also the potential around the idea of risk mitigation by collectively putting, obviously any fund would know this, putting certain projects together mitigates your risk because you're diversifying your portfolio, you are then also potentially getting access to capital at a lower rate. What springs to mind is something like, which is completely, it's not within the SME space, but in the municipal space, of how do we get secondary municipalities access to funding for their wastewater treatment programs. So again, Jonathan was involved in this, in the Sustainable Infrastructure Development and Financing Facility, where we really are looking at how do we collate a lot of different projects, which one project by itself is never going to be able to get the type of funding and the correct rate or appropriate rates for municipalities. We could obviously take this model where we take a bigger umbrella and put a number of these types of transactions together. And so obviously it's looking at how is it that the whole is greater than the sum of the parts. And I think that there's a great way and a way to develop that out in a climate finance space where we can do these smaller ticket sizes. Collectively, we're getting a bigger sort of asset ticket, but that these smaller projects can then sort of fall under the bigger umbrella.
Brilliant.
Cool, I'm going to pause.
I think I'd like to actually build onto that, because Jonathan, you've obviously in this space, we've spoken about the big banks, now we're speaking about something a bit smaller. What I found, and maybe correct me if I'm wrong, is that a founder of a company that gets even a small ticket and you utilize that money and you've got a good record, even if it's like 3 months worth or something and the project works, and you add that to your next fundraiser, people like to see that. They like to see if they do give you something, you know, you're bankable. You take the money and you do what you're going to say. So let's take a step back. We've spoken about the big tickets, but I think it's important. Let's talk about the small tickets and how do we get to the part where we can actually approach a bank and do a big deal.
So one of the areas that we need to build upon is microfinance. So banks do not have a problem lending to another financial institution. So they will take microfinance risk. Okay. What they won't take is, all the smaller companies that the microfinanciers fund too. So what I think, and I worked on a project, it was actually a development of an instrument, but they were looking to support microfinanciers to support smallholder farmers. That to me is a solution. But the extra solution to that is that the microfinanciers need some form of risk mitigation, guarantees, first loss, subordinated funding. And that's where the DFIs and the grant providers can play a role. So I really think there's an opportunity to develop microfinanciers across the board, agriculture, small businesses, where the banks take microfinance risk. They take the risk of the microfinancier understanding their customer. So they're not dealing with the customer. They chase them for money. They get the reports they need, etc. But we need to credit enhance the microfinancier. That's the challenge. And that's where I think the focus should be.
And the policy changes around that, because I don't know the exact terminology, but in Kenya, they can have, I don't know we call it like shark lending. South Africa, we're not allowed to do certain things like that. So with the microfinancier, is there any policy shifts that we have to look at?
There probably is. There's probably a whole lot of regulatory requirements. And that's another thing as well. We need to put some burden back on government. Government has to bring regulate.
Correct.
We know that the governments in Africa are fiscally constrained. We know that. And we know that we're going to have to rely more and more on the private sector. But we should still put the obligation on the government to create the enabling environment through regulatory reform. So I don't know, I'm not an expert on microfinanciers, but if there's a regulatory environment that has to be amended or has to be changed, well, that's incumbent on the government to do that.
Yeah, I think I can give an example of that to conclude maybe. We've been trying to bundle our insurance with the loans to de-risk these loans by microfinance institutions, but they are limited by how much they can add as fees. So we cannot make it compulsory for farmers to have insurance, and the products cannot scale. And also some insurance companies would like to test what we do, and they don't have the right license to do agricultural insurance. So there as well, the government could make a sandbox environment or allow for pilot scale projects to run without the appropriate license. So I think indeed the governments have a big role to play, not necessarily to bring the funding, but at least to make lift a bit the barriers. Yeah.
Well, I think we're 1 minute over time, and it's not as bad as I thought it would be. So thank you everyone for sticking around, and I hope you enjoyed that panel.